If you follow me on TikTok, you've probably seen me talk about my portfolio via a weekly update at some point. But for YouTube, this would be the first video where I'm talking about my $58,000 portfolio. In this video, I want to talk about specifically how I manage it, as well as kind of how I track it with my Excel tracker. The portfolio overall since its inception, which I started back in 2017, is around 15% in alpha generation, which we'll talk about that calculation a little later. Let's get into it. Track everything via Excel. I know, pretty old school, but it's a way for me to format the information how I want. And then I pretty much have some data input tabs where I'm importing all my information from Fidelity, which is the stock portfolio. And then I do track the options as well here, but in this video, we're going to be talking about just the stock portfolio. So the dashboard tab is where I kind of have an overview of where the portfolio is in terms of value, the top 10 holdings, tracking the dividends on a monthly basis. I also have it broken out by industry that I'm invested in, so you can see some of the highest percentages in my portfolio is payment processing, so more fintech, diversified retail, enterprise software, so things like Microsoft, social media. And if you scroll down here, I have it broken down by sector as well, and you'll see that my portfolio is pretty heavily weighted towards tech and finance. So tech, finance, and consumer defensive, I would say, are the three industries that I'm pretty comfortable within, and based on that, my percentage towards those industries are higher. And then cash/bonds, around 7.3%. For me, this cash position, I just raised a little bit just because I sold off some Disney, Starbucks, I sold off some Nvidia above 800, which was nice. So I have a little bit more cash than usual. I'm usually mostly invested. And then the bonds, this is more of something where you have the stock bond allocation rule with your age. So you take, 120, because I'm a little bit more aggressive, and minus my age to figure out, okay, in a bond stock allocation, this is how much percentage I would want. You can see that I'm under that percentage right now, just because I don't think bonds offers a great opportunity or return right now. So in my eyes, this bond position is mostly like cash. And if we did have a bigger pullback, 10, 20%, this is probably where I'd start to liquidate some of the bonds and move it into probably more growth positions. The other thing to mention is the market cap allocation. You'll see that a lot of my companies that I own are greater than 200 billion, large greater than 10, mid greater than 2, and small greater than 300 million. And what's interesting about this is just looking at it, you can see that I'm mostly geared towards larger companies that have a history, and I probably want to increase my mid-sized positions. It's only 3.5%, but a lot of growth names, if you can find really good companies for decent valuations, mid and small can offer the biggest returns. But for me, mega and large is where I'm kind of more comfortable. More stable companies, I can invest in stalwarts and fast growers, which brings me to the classification of types of investments I have in the portfolio. I have 6 categories, and it's slow grower, stalwart, fast grower, cyclical, and asset play, as well as turnaround. And if you don't know who Peter Lynch is, he's my favorite investor, actually more than Warren Buffett. But essentially, these are his classifications and how he kind of allocates or splits up his portfolio in terms of types of investments. And you'll see that I'm mostly aggregated in stalwarts, which are kind of blue chip companies that are growing a little faster than your average 8% earnings per share each year. You have the fast growers, which are the companies I probably like the most. Peter Lynch is kind of on the same board. If you're looking for growth over the long term, fast growers can obviously offer a decent amount of return. But slow growers, that's 20%. This is your Verizons and companies like that are very stable even if we have a downturn in the market. So if the market crashes 30%, that's where these kinds of companies kind of stabilize your portfolio, and you can rotate some of that into maybe fast growers that have gotten absolutely hammered, and you want to rotate some money into those. So that's kind of the dashboard. Then I also have some graphs that go along with it. Let's talk about this alpha though really quick. So the alpha generated of 15.52%. let's talk about the actual calculation behind that and why it kind of matters. And it's good to show, just because if you take the difference between the returns and the returns of the S&P 500 equivalent, it may be a little deceiving. So what exactly is alpha? Well, it's a measure of performance of an investment as compared to a suitable benchmark index such as the S&P 500. So kind of what I have in the portfolio. And it's showing the risk adjustment. The formula itself is basically the portfolio return minus risk-free rate, which you can use something like the 10-year treasury yield as a risk-free rate. And that's just saying pretty much if you invested $1,000, you're going to get a guaranteed rate on those treasury yield or treasury bonds because they're pretty safe. And then you have the beta of your overall portfolio, which shows kind of how much your portfolio is going to swing in terms of volatility. So if you're invested in really volatile stocks, well, if you're in a bull market, it's expected that those stocks are going to do better. Now, if you have someone that's in all growth and they just quote, oh, well, I beat the market, I'm up 30% and the market was only up 25, so I beat the market. Well, if they were in really high beta stocks that swing a lot, actually adjusting for risk, they actually may have underperformed based on that risk adjustment. With investors that take themselves serious, alpha is king. So this formula basically takes out the volatility as well as the risk-free rate and shows you how well you're doing against something like an index like the S&P 500. Another big part about growing a portfolio from $1,000 to $58,000 is you'll see not 100% of my portfolio is just gains, right? I didn't start with a $500 portfolio and grow into $58,000 over a few years. I started this back in 2017, and looking at the deposits, you'll see they grew a decent amount in 2019, 2020, but the consistency of saving money and using it towards investments is a big part of growing your portfolio, especially when it's smaller, right? Once you reach to something like 100,000, you start to get compounding effects where maybe the deposits are not as big as returns. But to start off your portfolio, personal finance is huge, and making sacrifices or trying to get extra income in order to grow those assets and grow your portfolio helps a ton. And I should probably talk about what this means in terms of S&P 500 or SPY value equivalent. Every time I deposit into this portfolio, I say that I'm simultaneously investing in the S&P 500 for that amount of deposit. At the same time, I can do whatever I want with that money, invest in any company, and I compare my total portfolio versus that S&P 500 value. And the reason I do this is, one, the S&P 500 is the benchmark for most investors, and you're looking to beat the S&P 500 if you're kind of managing your own money. That's kind of the goal. I have a Roth, I have 401k, stuff like that, where I invest in just index funds, whereas this is the portfolio that I'm playing mini fund manager, basically, to try to beat the market. Then we have the portfolio itself, where I track, the positions. I have a decent amount of stocks. Honestly, I want to be trimming this down. I've had this portfolio since 2017, so there are some ETFs as well as some smaller positions that I try to clean up when I think there's some better opportunities or my thesis on that stock itself has changed, and I'm trying to make this portfolio a little smaller over time. I'm not trying to do it all at once, but in kind of more of a calculated way. And if we go to the right, we'll see kind of some of the things that I'm looking at in terms of these stocks itself. So for one, I'm looking at the forward PE ratios, the PEG ratios, kind of the revenue expectations over the next 5 years, price to sales ratio, other things like tracking the kind of the dividends that I'm going to be making from each of the investments. And the big columns are A, B, and AC, where I'm looking at where I think the company is fairly valued. So that would be what it should be worth today, and then a 1-year target, so something that is kind of aggregating Wall Street estimates, or if I have one myself, and this is looking at where the company could be worth in the future. The big column that I'm looking at to decide, hey, do I want to reevaluate, is looking at where it's currently trading versus the fair value target, and if it's really overvalued, something like over 30%. I actually have a table over here where I'm saying, okay, if the fair value is kind of over 35% for a fast grower, maybe I'll take a look at it, 25% for a stalwart. And the reason I do that is to make sure that I can kind of trim positions that have gotten way out of hand. But other than that, I want to hold on to my positions as they just continue to grow their earnings. With that comes stock appreciation, and and making money. The other big piece is risk tolerance and timeline. For me, I'm 28, so I'm a little bit more aggressive than if I was retiring. It'd probably be more defensive than what I'm currently at. Some people may say they saw some bonds in my portfolio and be like, okay, boomer, like what are you doing with bonds? Well, I would say on a risk scale from 1 to 5, I'm probably a 3.5 to 4 on that scale. Some people are like a 7, right? And they're only in Palantir, high price to sales ratio stocks that are kind of more speculative. When it comes to the overall strategy of the portfolio, it's relatively simple. It's invest in good companies at decent fair values and just let them do their thing. So I'm investing in businesses. I'm not really trying to trade in and out of these companies too much. So I look at companies that I like in terms of the macro play, or maybe it's a sector that I don't have allocation to that I think maybe will do well in the current economic cycle. And I'll establish a position if I think the company is under fair value or around fair value and offers a decent amount of growth. Based on a week-to-week basis, I'm looking at, okay, which company do I think maybe offers a decent amount of return? And some companies may be trading what I think is above fair value, but I'm not trimming those positions. Just maybe because, okay, Amazon is 5% above my calculated fair value. I don't want to punish the portfolio and sell all of my winners and add to all of my losers. It's kind of a balance of, okay, I want to trim profits if something's really overextended. If it's a little bit above what I consider fair value, just let it run. Right? Just let the business continue to grow. And over time, that fair value will kind of catch up to their earnings or their earnings growth. Then I have a section where I talk about what I like in the market, some of the stocks that I'm looking to buy in the current environment that I think offer some good upside or maybe some protection for the overall portfolio. And then I give my thoughts a little bit on kind of the current environment and where I think the overall market may be headed in the short term. So I know in this video, we didn't talk about any specific companies or talk about juicy information. This was just more of a viewpoint of how I manage my portfolio with the Excel tracker, kind of how I think about my investments and how I go about creating an overall portfolio as well as managing it on a week-to-week basis. You can be even more active if you wanted. Some people may say, you know, the amount of positions I have is too high. It's really up to you on how many positions you want, how active you want to be, or you can take the very passive approach and just say, this looks like way too much work. Just give me an index fund and I'm okay with that. But like I said earlier, bit of a finance nerd, obviously have this channel, love talking finance, love talking investing. So that's just me. If you did enjoy the video, give it a thumbs up and consider subscribing to Main Street Wolf. I'll probably do more of a monthly update on more of what I'm actually doing in the portfolio. This is kind of just an introduction to the overall portfolio that I have that I talk about on my other platforms, but I can go a little bit more in depth on YouTube with the longer format. Hopefully give you guys some insights into what I'm looking at as well as kind of how I manage my mini portfolio. Obviously hope to continue to generate some alpha. Thanks guys for watching and have a great day.